Welcome to PortfolioCasts, the podcast where we break down real investor portfolios.
In this episode, we're exploring Michael Burry from Scion Asset Management's portfolio, the key holdings, the concentration, and the thinking behind it.
Michael Burry is making waves again with his latest filings for Scion Asset Management. We are looking at a very concentrated portfolio today. It is worth about $56,800,000 in total.
It is classic Burry. He is not interested in diversifying for the sake of it. He is running a lean operation. Right now, he is focused on just a few high-conviction plays. The portfolio is up about 3.3% overall. However, today has been a bit of a struggle. The total value is down 3.1% today.
That volatility comes with the territory when you are this concentrated. His top three holdings make up the vast majority of the fund. Let's start with the biggest one. Molina Healthcare is a massive position for him. It represents 43.5% of his entire portfolio.
That is an incredible amount of weight in one stock. He owns 125,000 shares. At the current price of $178.06, that position is worth over $22 million. He recently bought into this name. It shows he has huge confidence in the healthcare sector.
But the performance hasn't been there yet. He is actually down 7% on this position overall. Today alone, it dropped 3.6%. Does the fundamental data support this kind of heavy bet?
Burry is a value hunter. Look at the price-to-earnings ratio. It is sitting at 10.6. For a company like Molina, that is very low. Their earnings per share is $16.13. He is seeing a disconnect between the company's earnings power and the stock price.
The technicals are interesting too. The stock is currently at $178. But its 52-week high was all the way up at $359.97. It has lost over half its value from the peak.
Exactly. He is buying the blood in the streets. Recent news shows analysts are just now starting to assess if the valuation is fair after a slight rebound from the lows. Burry got in early. He is betting that the managed care space is oversold. He is looking at that 52-week low of $133 and betting the floor is in.
It's a bold move. But it isn't his only big bet. Let's talk about Lululemon Athletica. This is his second largest holding at 32.4% of the portfolio.
This is where we see his contrarian side. Most people think of Lululemon as a high-growth retail darling. But it has been hammered recently. Burry didn't just hold his position. He added to it by 100%. He doubled down.
He now holds 100,000 shares. That is worth $21,399,000. And unlike Molina, he is actually up big on this one. His overall gain is 20.3%.
It's a great call so far. The stock is trading at $213.99. It's down slightly today by less than 1%. But look at the valuation. The PE ratio is 15.2. For a premium brand like Lululemon, that is historically very cheap.
People are worried about 2025. There is a lot of talk about whether these retail losers can turn it around. The 52-week range is wide here too. It has been as high as $423.
Burry sees a company with an earnings per share of $14.44. He sees a powerhouse brand. He is clearly ignoring the Athletica is dead narrative. He doubled his stake because he thinks the market is wrong about the consumer slowdown.
It's interesting to see him balance healthcare and consumer discretionary. But the third pillar of his current strategy is in financials. He has a major stake in SLM Corp, also known as SLM.
This position accounts for 24.2% of the portfolio. He holds over 480,000 shares. It is worth about $13,158,000.
This one seems a bit more troubled lately. The stock is down 2.6% today. He is down about 1% on the position overall.
There is some noise here. Recent news highlights class action lawsuits. They are challenging how the company discloses loan delinquencies. That usually scares off most investors. But Burry often seeks out companies facing temporary legal or structural clouds.
The numbers on SLM are very Burry-esque. The PE ratio is tiny. It is only 9.2. Plus, it pays a dividend yield of 1.87%.
He is getting paid to wait. The earnings per share is $2.91. The stock is trading at $27.41. It is much closer to its 52-week low of $23 than its high of nearly $35.
So he has 43% in healthcare, 32% in retail, and 24% in student loans. That is a very specific map of the economy.
It really is. He is avoiding the high-flying tech names. He is avoiding the AI hype. He is looking for cash flow and low valuations. Between these three stocks, he has almost his entire $56 million at work.
It's a high-stakes game. If Molina Healthcare doesn't turn around, it drags down almost half the fund. But if Lululemon keeps climbing toward its old highs, he looks like a genius again.
He is used to the pressure. He is looking for that deep value. He wants companies with solid EPS that the market has abandoned. Whether it's lawsuits at SLM or a price collapse at Molina, he sees opportunity where others see risks.
We spent the first half of the show looking at the heavy hitters in Scion's portfolio. But Mike, I want to pivot to some of the names that might surprise people. Let's talk about Molina Healthcare. It seems like a classic Michael Burry play, doesn't it?
It absolutely is, Sarah. Molina Healthcare is currently a significant position for Scion. It represents roughly 7% of the total $56,800,000 portfolio. Burry has always had an eye for the managed care space.
What is the fundamental story there? Why does he like the specific provider?
Molina focuses primarily on government-sponsored healthcare programs. We are talking about Medicaid and Medicare. This business model is very resilient. It doesn't rely on the whims of the consumer economy. The company currently trades at a price-to-earnings ratio of about 14. That is quite attractive compared to the broader market.
And what about the technical side? Where is it sitting in its current range?
It has been a bit of a bumpy ride lately. The 52-week range is between $307 and $404. Right now, it is trading closer to the middle of that pack. Burry actually added to this position recently. He increased his stake by about 15% in the last quarter.
That shows a lot of conviction. He isn't just holding, he is doubling down. Now, let's switch gears to something more consumer-facing. Lululemon Athletica is in the portfolio. That feels very different from a Medicaid provider.
It really does. Lululemon Athletica is a fascinating inclusion. This is Burry playing the contrarian role again. The stock has been punished recently. It is down significantly from its 52-week high of $511. It even touched lows near $220.
Is he betting on a brand turnaround? Or is this purely a valuation play?
I think it is both. The price-to-earnings ratio has compressed to around 20. For a high-growth retail brand, that is historically very cheap. Burry started this as a new position. It makes up about 5% of the total Scion portfolio right now. He is looking at their massive margins. He likely thinks the market is overreacting to a temporary slowdown in North American sales.
It's risky, though. Retail is so fickle. Does the data show him trimming any of these newer bets?
Not yet. In fact, the latest filings show he is maintaining the Lululemon Athletica position. He seems content to wait for the market to realize the brand's global potential. He is especially focused on their expansion into China.
Let's move to the third name on our list for today. SLM Corporation, better known as SLM. This feels like a deep value play.
You hit the nail on the head. SLM Corporation is the leader in private student loans. It is a smaller position for Scion, roughly 3% of the total value. But it fits his unloved criteria perfectly. The stock has a very low price-to-earnings ratio of about 7.
7? That is incredibly low. Does it offer a dividend to sweeten the deal?
It does. They have a dividend yield of around 2.3%. They have also been very aggressive with share buybacks. Burry loves it when management returns capital to shareholders, especially when the stock is trading at such a discount.
What is the news flow like for SLM? I know student loans are always a political lightning rod.
That is the main headwind. There is constant talk about debt forgiveness and regulatory changes. But the private loan market is different from federal loans. Burry likely sees the regulatory fear as overblown. The stock has traded between $14 and $23 over the last year. It is currently showing some strength near the top of that range.
We are looking at a portfolio worth $56,800,000. Today, the portfolio is down about 3.1%. Does that daily volatility worry you, Mike?
Not when you look at the big picture. Despite today's dip, the overall gain for the portfolio is sitting at 3.3%. You have to remember that Burry is a high-conviction investor. He runs a very concentrated book. When you only hold a dozen stocks, a 3% daily swing is perfectly normal.
It's the price you pay for seeking alpha. He isn't trying to hug an index.
Exactly. He is looking for those big short-style asymmetric returns. He wants limited downside with massive upside potential. We saw him trim some of his larger tech positions recently. He is moving that capital into these value names like SLM Corporation and Molina Healthcare.
It feels like he is bracing for a shift in the market, moving away from growth and into real earnings.
That is the classic Burry playbook. He is often early to the party. Sometimes he is a year or two early. But when he is right in a massive way. He is looking at the macro picture. He sees high interest rates and a tired consumer. That is why he is picking these specific spots.
As we wrap up, what is the one big takeaway for our listeners?
The takeaway is concentration. Most retail investors are told to diversify into 100 different things. Burry does the opposite. He finds 5 or 10 things he knows deeply. He puts his $56 million behind those ideas. He accepts the volatility because he trusts his research.
It takes a lot of discipline to watch your portfolio drop 3% in a day and stay the course.
It really does. But that is why he is Michael Burry. He doesn't care about the daily noise. He cares about the fundamental value of the businesses.
Well, that is all the time we have for this deep dive into Scion Asset Management. It is always a wild ride when we look at Burry's moves.
It certainly is. Thanks for having me, Sarah.
Thank you, Mike. And thank you all for listening. We will see you next time on the Financial Pulse. Thanks for listening to PortfolioCasts.
This content is for educational purposes only and should not be considered financial advice.
Any figures, prices, or portfolio values discussed are approximate and used for illustrative purposes only.
Follow PortfolioCasts for more investor portfolio breakdowns.